One of the aspects of my business is that I would help a lot of my entrepreneurial clients that maybe ran a restaurant or ran a school to acquire the building they're in using an SBA loan, and they could pay rent to themselves, or their business can pay rent to the building
Yeah.
that they own, and just kind of work this dynamic of getting rent from their own building.
Welcome to the Yacht Captain Investor Podcast. I'm your host, Scott Kidd, where every week we dive deep into conversations with real estate pros, business owners, and maritime professionals about their mindset and journey to success. Please help support us on our journey and our channel by liking, subscribing, and commenting below so we can help you in your journey to success. Get one of those things going, like on the other side of the bay from San Francisco, I think, something like that.
Yeah, no, that in the city of El Cerrito,
El Cerrito, yeah.
It's only like 10 minutes from my office that I'm talking to you from.
Yeah.
But it's in what's considered the Bay Area. Like, so my office is like 15 minutes from San Francisco.
Okay.
That's still going. I mean, I still own it. Still the only investor. I have a bunch of people who've expressed now that they'll participate, but I had created multiple tranches for being able to do it, right? So like I have I paired with one of my he's now a partner of mine, and we've just been raising capital through through a C, and but we're doing it as debt, where just minimum $50,000, 10% annually, 20% ROI, return it in 2 years. But I've been kind of using it as a platform for other discussions for maybe larger players that might put in $2-3 million into the deal.
Okay.
And then they might want an IRR. One of my local clients that we had, he had expressed that he'd put in anywhere from 2 to 3 million. I just needed to bridge the difference and break down exactly what kind of a loan I'm going to get. Because on one side it's a project that's approved for modular, putting the whole crane up. But my God, it is just like so difficult to get banks to do a modular loan that I'm looking at doing it stick right now. And I just sent out, I'm waiting for a bid to come back stick, right? So like, whereas like if it'll take me 12 months to get my certificate of occupancy and start getting this thing rented out, if I go modular, I may have to just rely on doing it the good old fashioned stick method, and it'll be a 24 to 36 month period, probably closer to 28 month, right? But I have to be very mindful of coordinating just the right timing for getting the power switched on with PG&E. PG&E is our local electricity provider, and the reason why they've been really slow is because they've been on this mad rush to electrify all of California. They have this mandate for having no more gas in California by 2030, right? Trump just repealed the California EV mandate, which thank goodness he did, because like this year, any landscaper with gas-powered motors couldn't use it anymore. It's just so. I mean, they're right. They're. And again, I would love to have everything go EV, or like electronic, but like for example, like all my buddies who work in PG&E, these are the engineers and the linemen who are trying to get the infrastructure up. They're like, there's no way we're going to make it to 2030 and have enough infrastructure. The moment we go all electric, we're gonna blow out our circuits.
I know it's like everyone, while it's a grandiose idea, it's like no one thought about the hybrid period or the interim period or the build out, like, because we need 50% more power, 50% more of the grid, the infrastructure is not gonna, it's gonna take years to do all that.
And the main reason it takes years is because one of the other things they have to use is, and again, we have it like in deuces or whatever, is the permitting process in California is just beyond ridiculous, right? And so it's not as though it takes that long to actually build it. A lot of it is just bureaucratic red tape.
Yeah.
And, when you've seen it evolve from where it was at, what permitting process it was back in 1998, in 2000, 2004, like when I was just getting permits. And then when I'm really deep into it in 2004 as a developer, and then now to 2025, it's just ridiculous. Like we could do a whole show on, and I
Yeah.
do a stand-up comedy routine on this of
Yeah,
that.
because I was listening to a guy in California in the LA area, and he was saying that had these government like housing things for, I guess, homeless people or displaced people or something like that, and then
They're homeless. Yeah, displaced people is just a kind, right?
they said they weren't technically homeless, but there was, I don't know, they had some weird. It was some certain segment. It wasn't exactly just homeless people, but it was like $1 million a unit. And I was like, any other builder anywhere could build it for whatever it was, probably 200,000 or whatever or less per unit, and then maybe California a little bit more. But then they said it was just because of all the regulations and all the time backs and everything else.
It goes deeper than that.
Yeah.
It goes way deeper than that. So on top of the regulations, whenever you hear nonprofit or housing, they pad that crap so heavily on developer fees because they're getting tax credits to pay for it and things like that. Where like, of course, it costs you $1 million, right?
Yeah.
Like, for example, I have down the street from the 54 unit that I'm trying to build, I have a listing for a 90 unit building, right?
Okay.
And same exact situation where it's fully entitled, fully building permit, ready approved, ready to go vertical. The owner of that, a guy named Kevin, who's my client, I'm just acting as the listing broker. He's building another property in a downtown city called Berkeley, right by the college, UC Berkeley.
Yeah, Berkeley, yeah.
And he's like, I don't have enough to do both, so let's put this one for sale. So I've gotten offers from nonprofits, right? And then they say the same thing, like, oh, can he come down on the price because our cost per unit is just prohibitive. And I'm like, can I break down and see where your cost per units are? So I started going through their expenses, and I'm like, well, yeah, that's because you're getting like this much more money and developer fees. Like, what do you? Anyway,
I mean, just to ask, I mean, what kind of development fees are they charging?
Like $2 million in a developer fee, right?
So how much is the project?
So the project should cost about 28 to 30 mil to build, right?
Oh, wow.
I've gotten cost for stick build to do it. And, so like my project's going to be like 20 mil to build.
So that's like 8%. That's like 8 to 10% if it's at 20 to 30 million.
Yeah. Well, so it was costing them to build it, like, according to their numbers, about 40 mil, right? Okay. And like maybe, and it might be at a 45 mil, right? They said, and that's before you apply what the rents are, right? And I'm like, well, can I see your numbers? And so it's so heavily padded with developer fees and kickbacks. In fact, it's beginning to come out, like, especially because people are looking very closely at this Doge, through Doge and stuff like that. But then there's a lot. I think that's why you get so much outcry against Doge, because it's like they're looking in.
Yeah.
It's just, no
people are upset they're getting caught.
Yeah, exactly. So let's go burn a Tesla because that's gonna we're gonna look,
because that's got anything to do with anything.
Exactly. Yeah. So, but. If like on mine, if I do go stick, I'll probably just keep it going. It definitely can't appeal to nonprofits because nonprofits it's a lie, right?
It's not. It's really just another business that doesn't really need to make money, so they give less than 3 or 4% to the cause, and then they get all the write-offs and everything else.
Exactly. because like you can't spend $1 million to house a
No.
person. In fact, the number I got for like a homeless housing project in Skid Row, okay, Skid Row in Los
Yeah, yeah,
Angeles,
yeah, yeah.
famous, because of like it's been
Band.
written songs
And
about it.
yeah, yeah. And there's a band in Skid
Yeah,
Row or whatever
so
it
they built this homeless housing, and it looks gorgeous. Like, what are they doing? They spent $650,000 a unit for homeless housing. So just like, yeah, but
Well, that's like it's funny because it's a similar thing. I remember one time when I lived in Fort Lauderdale, they built these toilets on the beach that had these special locks and everything. I think it was $1 million, something like that. And it was like four toilets or something, a
yeah,
men's and a women's room. And I was like,
no,
oh,
there's a
somebody's skimmed off some money there.
there's a diametrically opposed, situation whenever it is nonprofit, or because
Yeah.
they just have this incentive to tax the heck out of you, like they just create line items for different fees, and like you might as well you can make up stuff like a PIA fee. It's a pain in the ass fee,
Yeah,
like
yeah, yeah, yeah. That's a new. I mean, I've heard that one, but I'm sure someone probably actually put it on the.
they weren't that brazen, but basically it was, if you really got down to the brass tacks of what they were trying to define, that's essentially what they're trying to say. And so it's just, ridiculous. But
Well, before I forget, I wrote it down after we get off this. I'm gonna call after the podcast thing here. I'm gonna send you a friend of mine that used to live in the San Francisco area. He's now here. I'm currently in Newport, Rhode Island. He's a developer over here, and he's always been interested in building and doing stuff over there. So maybe at the very least, you guys can talk or what have you.
oh no, I'd
Maybe
love
there's
the connection, Scott.
maybe there's a connection there, and maybe you guys can do something together, or not
What
now,
is he?
later on. Tom. I'll send it. I'll connect you guys. That way you guys can do that because he's doing some pretty interesting projects here in Rhode Island, a lot in Providence and stuff like that, and so really cool stuff that he's doing. So and then a lot of the stuff that you're doing, I know, and I know your boots on the ground. You know what's going on everywhere there, and that's pretty critical, especially in a place like California, where it's definitely a nuanced insider's game. I wouldn't even begin to think about doing something over there unless I had somebody like you that was involved, because it's not going to be your average project. One, it's going to cost a lot more than I think it's going to cost. Plus, there's all the other impact fees that are going to come even before you even get started. You know,
Yeah, yeah.
you
Well,
know.
thanks. I appreciate that.
Yeah, no, not a problem. That's why I enjoy doing that because it's what keeps the world going around. Is us meeting more and more people. That's why we do the podcast. That's why we get on and talk, and I keep communicating because there's people like us. We always find a way, right?
Yeah, no, definitely.
Yeah, if there's a way, we'll sniff it out. It might take some while and might have to beat our head against the wall until we either break through or figure out there's a door on the other on the
Exactly.
other wall, or maybe we build a door or something.
Yeah.
you know. But so that no, that's a pretty interesting project, because I've talked to last year I talked to a lot of people that were doing those modular homes, and I found like some of them will do the debt, but they'll only do it if it's like over a certain amount, project 50, $100 million or something like that, because
Yeah.
they have to be able to do it at scale. And come to find out, a lot of them have deals with the modular home builder. So you got to watch some of those fees that are ingrained in those costs in there, where you may not necessarily get those discounts.
Yeah.
You know?
Well, it's a lot of the modular builders, they actually get ingrained with the nonprofits. So they'll build those at ridiculously higher costs because they're padding it up.
Oh,
Yeah. And
you're
so
getting lower
that's,
quality.
yeah,
You know.
yeah.
Oh.
So I've seen that happen before. But like, for example, in that same, when I was looking at the numbers of the nonprofit that were trying to make an offer on the 90 unit that I had listed, I was like, oh, and I started running the numbers myself. I'm like, I can get this thing built for like, 30, 32 to 33 mil, right? Not 45 mil, because its future value is only going to be about like 45 mil to begin with, and
Oh,
maybe,
wow.
43, right? So if you're building it for 32 and its future value, the way you start is like 45, then you got that equity there.
Yeah.
The moment you get it, you get people plugging in and you're starting to raise those rents, that equity is just jumping like significantly year one, year two, year three, especially when you're applying 7 to 8% annual rental increases, right?
Yeah.
It's
Yeah. Yeah.
become more the norm, especially because we're so regulated. And they're both in a city where it doesn't have um, its own city rent control. It's just got California's regular rent control, which is totally workable. And then, of course, because they're new, they have that sunset period where it doesn't even apply. So you can just like ratchet up the equity just as a rental in those first 15 years. And, there's all kinds of, you could condo convert any of these 54 or 90 unit at year 10, preferably year 11, and then sell them off as condos if the market for condos is high, and then just exit that way too. I
Mm.
always use 10 years because then you don't have the lawyers chasing you and encouraging all the homeowners you put in there to sue the developer for construction defects. It's no longer something they could pursue, right?
Oh, really?
Yeah.
Oh, well, you just mentioned, the California rent control. For people that don't know anything about that, expand a little bit on that and how that all works.
Oh, well, in California, they recently passed, I want to say recently, about 7 years ago, a statewide rent control. And at its core, the main thing is that it's a maximum 5% annual plus whatever the CPI index is that appears on April 10th of every year. So,
Okay.
for example, the consumer price index that appears, I think it's on April 10th of every year, is an average of like 2.5. Now, in times of inflation, it ratchets up to as much as 5%, right, or 4.5. So when you take that 2.5 plus the 5%, you get a 7.5. And of course, during high times of inflation, it gets up as high as 5. It's a 10%, right? It's 5 plus 5, or 9.5. Now, as a landlord, you still have to kind of look at, well, what will the
And they
market
pay.
bear, right? Because if I am allowed to raise the rent on that tenant, 7% or 10%, but it's going to cause that tenant to move out,
Yeah.
because you have more inventory, you still have that room to mitigate. But as a landlord, you're always doing that anyways. And
Yeah.
as long as you're able to keep those annual rental increases between, 6 to 10%, right, or 6 to 9%, you're increasing the value of your property, especially the more units you have, by
Yeah.
several hundred thousand to up to $1 million a year, right? So you pull that out, you're building all this equity. Um, what happened in some of the cities in California is that they started imposing their own rent control. Like, so for example,
Mm.
San Francisco, across the bay from that, Oakland, Berkeley, where you have, UC Berkeley is the big draw there.
Yeah.
And then neighboring city like Richmond, they started imposing their own rent control that superseded California. And their rent control would look something like 1% annually, right? And then all kinds of other rent protections that protect the
The tenant.
tenant from being evicted. And they made the whole process of notifying the tenant that they're late and that they might be evicted, like a 3-day notice to pay or quit, a bureaucratic red tape nightmare, right down to the
Mhm.
font having to be the correct size. And in some cities, they
Really?
impose, like, before you get the 3-day notice, you have to get the 5-day notice to say that you're rent, and you'll get a 3-day notice. And each city has its own, right? And
Wow.
so and these are usually the cities that um, that have the greatest need for housing because there's not enough of it. And what happens a lot of times in, like, for example, the biggest historical study was the city of San Francisco. You have people that were on rent control in the 1970s that still own their apartment unit or pay rent at this ridiculously low amount. And so, of course, it keeps that property, that unit, off the market to somebody who really needs it. And
Yeah.
those people are actually now super rich, own
Yeah.
a couple pieces of real estate, but they keep that one because they're only increasing 1 or 2%.
Probably paying $500,
Yeah.
$1,000 a month or something like that.
Yeah. And so you have to look at the property you're going to either buy if it exists already uh, in its location. Is it in a location that is just applicable to the statewide rent control, or is there a specific more, is there a city rent control that's more stringent? And because you have had cities like San Francisco do that, there has been a trend for other cities in California to create their own rent control. Like more recently, a city called Concord, California, which is closer to me, imposed their own rent control. San Diego, which a lot of people recognize, that has a really stringent rent control there as well that gives all kinds of tenant protections. Like, for example, if you know your tenant is dealing drugs out of their apartment, you can't evict them, right? You have to be able to prove that they're dealing drugs or doing other things, right? And so it causes you to have to go through these, like they call it just cause, right? Proving up and almost becoming the detective. And of course, the laws or the police have also been really stripped of what their ability to do or to investigate crime. And so between those two things, it makes it really difficult to own property in certain cities, depending on the type of rent control they have. But outside of those cities, and it's still very lucrative. You get a proper project, and it really puts off a lot of increase in equity. So it provides a great exit strategy, but it also still provides enough cash flow after even paying a mortgage, where you get a pretty a good cash on cash return year one. Like you might get a cash on cash return of year one of, let's say, 5.5 or 6, but because of that rent control, it's going 6, 7, 8, 9, 10, and by like year 3, you're at a 11% cash on cash return and climbing. And this is after paying the debt, right? So you just got to be able to look at all the angles from not just cap rate, definitely not gross rent multiplier, but what is my actual cap rate? What is my actual cash on cash return? Especially if as investors, we all like to leverage our money. If I've got debt involved, right? And then just be very stringent about the taxes that you're going to pay. And then more importantly now, the kind of insurance. So the newer property, the better the insurance, but a lot of the older properties or older assets like family, insurance is just shooting it down or giving a notice that we're not going to renew. Sometimes they're nice enough to tell you we'll renew if you upgrade your electrical, right? And again, it's tied to fires, certain electrical components that went out. So again, all that ties back to this rent control, right? So you have some cities are imposing that you do these types of repairs or upgrades as well as like foundational stuff. So that's what a lot of investors going into California have to be aware of. I've been doing it so long here, it's like breathing. So it's just like, and I have had that opportunity, like I mentioned before, to own in Texas, own in Arkansas, Tennessee. I owned stuff in Florida before. I was a broker there. Maine, New York.
Wow.
So, you can compare those different areas and Arizona. And so, you always get these great immediate cash on cash returns typically when you invest out of state. But then over the long haul, and they tend to be more stagnant. You don't see that exponential
equity pop. You don't see that equity pop at the end or the large equity gain like California. Well, are you seeing actually in your area 5 and 6% rent growth? Because in some areas of the country, it's fairly flat, or it's some places are negative now, and some places are maybe 1 or 2%. And
Oh, great question. Um, so we are still seeing an average of 5 to 6% rent growth in certain areas.
wow.
Now, let me be really clear. Um, I don't know if you guys had this in your area, but during the COVID crisis, right, there was a moratorium on evictions.
Yes.
Of course, that was like, hey, you can't evict me, so I'm not going to pay you rent.
Yeah.
And so that also locked up the inventory significantly. But and again, this did not happen statewide. This happened again in those similar cities that I mentioned, like San Francisco, Oakland, Richmond, whereby the law they imposed extra, moratorium time even after the moratorium time that was statewide was lifted. So when they finally unlocked the moratorium on evictions in cities like San Francisco or Oakland or whatnot, then all of a sudden evictions spike up, and then people are moving out, and then you suddenly have a big amount of inventory entering the market because of all these massive vacancies. And so in those specific time periods, you have seen rents drop, right? So like I own an apartment complex in Berkeley, and the rents were very high, and I've always maintained 100% occupancy in this place, but when people did move out, as they do over the last year or two, and then this is long after, they still had a lot more inventory to go after. So when I'd have to lower my rents in some of these places
Oh, wow.
in order to get somebody in. It's still, I mean, lowering the rent, is still, going from something like that's $2,500 to $2,100. So it's still a high amount of rent, respectively.
Yeah.
It's a
Yeah.
$400 drop at the worst, and it would be in specific cities. Now, in areas that were not affected by that huge influx of inventory, the rents have stayed consistent. And again, just another plug for why rent control, although it's actually unconstitutional, doesn't really provide safer protections for people who are looking for housing. It just locks up housing for other people trying to get in, and
Yeah. It's a race to the race to the bottom, because then ends up the landlords start getting to a point where they can't sell, or they can't, if they do, they're not keeping up with inflation and stuff like that. And then they have to sell it, and they're just sell it at whatever price. And then it just kind of keeps the prices lower, because no one's going to be able to come in at that price if it's locked in at rent control. And then, no, also they can't, their costs are going up. So then, their expenses are higher. So they need to raise the rents to cover those. And so they're not able to do that. So it ends up kind of being detrimental rather than being,
well, interesting. In most cases, you think that, right? But remember how we were talking earlier? How usually we'll find a way, right?
yeah, yeah,
Keep knocking our head into the wall. So
yeah.
speaking to that exact thing, right? I mean, there was a market for people buying existing apartment complexes, but factoring into the costs of that, the buyout costs, or what we call relocation costs, that somebody would have to pay a tenant to move
Oh,
out of their low paying rent, right? So there's exact calculations on this kind of stuff from city to city.
okay,
Like,
okay.
are you a veteran? Are you a senior? Are you disabled? Are you a student? And so now these buyout costs could get up there pretty high, right? And so you run a calculation. I've done some of these, and you say, hey Scott, you've had your place for rent control, and I want to buy you out. And according to this chart here, I should start with $25,000. How does that sound to you? Now, of course, you are also given an attorney that advocates for you and says, now that's just guidance.
Yeah,
You can ask for more, Scott. And
yeah.
so, some of these buyout costs can be, as much as like $50,000 to give up your
Wow.
paying tenant unit. But on the other side of the equation, you can calculate like, well, okay, if I fill in someone in there at market rent, because you voluntarily left,
Mm-hmm.
market rent is that loss to lease is so great that, from what you're paying as the tenant under
The
rent control,
market is much
market
higher.
there. that someone will go in there and pay so much more. And so you do that enough times on a multi-unit, you suddenly add up all your costs from acquisition to buyout cost. And you go, here's my cost basis. But by putting all these new people in rent control that are paying market, even though they're going to start at new rent control, I just shot my property's value up
I did not
way
realize.
in excess of what I bought it for and paid Scott, $50,000 of extortion money for.
Yeah, I did not realize that you could actually do that because when somebody moves out, it goes to market. It doesn't stay at that same nominal rate. And if you
Yeah.
do, like in a lot of other, states, same similar thing they call a cash for keys, where you rather than evict them, you give them some money to where they can relocate, and you tear up the lease or what have you, and you don't
Well,
deal
I
with
wish it was cash for keys. It used to be like 1,000, 2,000 bucks.
2,000, 5,000,
Yeah. Yeah.
but 50,000.
Yeah.
Because
So, so
if it's 25 and you get a lawyer, it's definitely
yeah.
50,000.
Yeah. So let's suppose you pay somebody 50,000. Part of the negotiation, because I remember I'm a real estate broker. So I'm like, hey, Scott, if landlord's going to give you, $50,000. I looked at your rental application. You work at this. You work here. You're an engineer. You make this much money. You could use that 50,000 and buy a house with 3 or 5% down. Here's your mortgage, and you can see it's less than you're paying in rent. And so we will use that as an extra way to
Oh, that's
pay people
brilliant.
down and then
That's
sell you
brilliant.
a place. And then
Yeah.
at some point when you move out and rent out your place, karma will come to get you, and you'll be on
Yeah.
it. So
Yeah.
it's just a big cycle. So
Yeah. So I
just
guess,
getting
that's
all
good
from
because
business.
you have a multiple tiered strategy of, because you being a broker and also an investor, and also you were doing mortgages as well too, right? Is that
Yeah,
correct as
yeah,
well? So you understand a lot of the different nuances and all the different strategies in between doing that, so you have a few more options than the majority of people for giving also the tenants options for moving out. Say, hey, that 50,000 that you're going to get when the place closes, you'll get for the relocation.
yeah,
That's really great. I did not know that it was upwards of 25,000 or whatever for relocation. Cash for keys is sounding pretty great right now, actually.
yeah. Well, so you're gonna laugh. Some what I've done in some instances when they're depending on how much they're getting, right? I'll say, hey, you can buy this fourplex with FHA, and you could live in one unit as the owner and rent
Yeah.
out the other three, right? Of course,
Yeah.
now they're the landlord, and then
Now
you
they
know,
don't want rent control. They don't want.
yeah. Well, it sounds really great. It is, I mean, but now they're dealing with tenants, and like a year later, they're like, I you did this intentionally to me, didn't you?
You reverse karma them.
Yeah, I reverse karma on you, and you're like, I mean, like, is it really this? Like, yeah, that's
Yeah,
where
I
you
have
get
plenty of
down.
these. This is all day long. This is what I do. Like you were just one resident in
Yeah,
one of the buildings, and
yeah,
then multiply this by hundreds, and
yeah,
this is and it's easy to think there, because a lot of times we get a bad rap as the greedy landlord or what have you. But a lot of us are taking the risk by putting up the money or putting in the work and fixing up these places, and making it livable for these people. And none of us want, at least most of the people that I've met that are investors, we don't want to be slumlords. We want a nice place for people to live that are that the people stay in there and they feel safe, and they got their families and they got their friends and everything, and they stay for a long time and continue to pay the rent, because that's you're losing one tenant. No matter how many units you have in the building, turnover is one of the biggest detriments to the overall business plan. Losing, that's everybody I know that's successful about it. They put a lot of effort into keeping the tenants happy and keeping the tenants there and keeping a nice place and fixing stuff on time. Granted, you can't always do that because maybe you have an older building and takes you a bit of time to get over that hump.
yeah, yeah.
Yeah. It's
No, no. Yeah,
interesting.
well said. Well said. Yeah. Another little fun story of that on that exact same basis. Like, so, on my profile, I'm a movie producer, right? So I produced a movie, we sold it to Netflix. So opened up this door to the entertainment industry in Hollywood for me, of like hobnobbing with like other producers and actors. And so, one of my clients was an actor on a TV show, right? But he was, and he's starting to do well. But he lived in one of these rent control units in Los Angeles, and
Oh wow.
the owners of the building. This was like, I want to say it was like 150 units, right? And they wanted to buy him out. Now they wanted to convert these apartments into condos, right? And they were in the location was right. So of course I was helping him to negotiate his buyout. And then he had gotten such a substantial amount that I actually put him into a fourplex and a house, right?
Wow.
An actor, right? So we did a fourplex with 3% down, and he got that, and he was like, yeah, karma's gonna come back to get me, but like I've got you to help me through this stuff, and then he bought another house in Las Vegas with his parents with 5% down, right? Because when you buy an FHA fourplex, you get that 3% down because you're owner occupying it and you don't
Yeah.
have any other residences on your record on your credit report. But you can take advantage of another first time buyer opportunity because now you're upgrading.
Yeah.
So long as you don't buy another fourplex, you're buying like a house or a duplex. You're putting yourself in a better situation. So within about 6 months after getting the fourplex, from the buyout money that he had to give up his unit so that the owner of this
You'll be
100
able to get
could
two. That's
convert it into
great.
big condos, he got a house out of it in Las Vegas. And part of why we went to Las Vegas was, again, when he's an actor in California, and we're taxed ridiculous
Yeah.
amounts in California, federal and state, and then all this other stuff. So I said, well, you should relocate your legal domicile to Las Vegas, where they don't have state tax, because if you're working on a gig in California, you're going to pay taxes on that money. But half the time you're working out of state
Yeah.
and sometimes out of the country. So have your money from those, acting gigs come to your legal
Las Vegas
domiciles
it
in
is.
Nevada. Don't pay
Yeah.
that California tax. You're just going to pay the California tax on the California income from your California properties or the gigs you do
Yeah.
acting in California, right? So it was, but it was that little fun story that kind of saw the other side of the recipient of that rent control money or buyout money
Yeah. Yeah. Well,
to
that's good because it's all useful, I guess, in each instance. It has its purpose, because you don't want to throw, none of us want to throw anybody out on the street or anything like that. That's, not unless they're doing something illicit. But getting back to that point where you have to prove that they're dealing drugs, that's a pretty awkward situation because you're talking about hiring detectives and doing things like that where most people probably don't have enough to where they're able to do that, and that makes it really prohibitive, especially if someone's dealing drugs or doing something illegal in the property. It's not, I guess, gone are the days of if someone you know is doing something like that, you can't just say it's a lease violation. You have to have actual proof, because I know during COVID, like there was in a lot of states, and I know Florida especially, they had where if people weren't able to pay, then they could stay. But then there were some restructuring of the loans and stuff like that. But I know that there were some other workarounds that people did, where if there were other lease violations that didn't have anything to do with not paying the rent, then there were things like that. Like if they had a pet and they didn't have them on the lease or anything like that, then just simple like that. So there's always different legalities in every city and every county. There's just definitely real estate is local, and California, each locality in California seems to have all their own nuances as well, especially with
Yeah.
you guys are talking about.
Specific cities have their own nuances, yes.
Yeah.
Cities without their own rent control, it's the blanket statewide rent control that um, it's totally workable. I mean, you still have things like just cause and everything like that.
Yeah.
Um, it's not nearly as difficult.
Well, and that's good to hear because California gets a bad rap for stuff, but you obviously got a lot of it figured out after a lot of banging your head against the wall and going around and having to be a sales broker, a mortgage broker, an investor, and a movie
Yeah, yeah.
producer to find a way through some of these solutions just from all these different businesses. That's really creative.
No, definitely. And a lot of it just was seeing it change throughout the years, and then a big part of understanding a lot of these workarounds too was just being able to have built the multiple vertically integrated companies. So a lot of these things, like my on the property management company, I have a partner who was like total godsend. Mark Guzman, and he actually enjoys managing properties,
Oh wow!
and
I gotta meet this guy.
yeah, and then we get, but so he and I, what we share in common is we like to get down to the nitty gritty of like the specific law and what it says, and then or the tax law and what it says, and so we've come up with different ways throughout to kind of navigate all those different things, and it just kind of just becomes a challenge, right? Like you're playing a game, you know.
Yeah, yeah.
Plus, it's like it's chess or funny thing, I was on LinkedIn. Somebody had posted this thing about how using strategy in real estate is just like miniature gaming. I don't know if you're familiar with Warhammer 40,000 or these miniature
No,
games.
no, I'm not. But
So I looked at the picture and I was like, oh my gosh, yeah, he's a gamer like me, right? So we play these miniature games, but it's that same mentality of like figuring out the rule base on these miniature strategy games that you would get down to like crackhead focus to like
that's pretty. That's drilled down pretty far.
yeah, yeah. We're
Well,
like, okay, I'm going to apply this law against you because you're applying this law against me, and you got your attorney, and it's my attorney against your attorney, but I'm going to have to help my attorney to figure out how we can mitigate this situation. But that it's become more of that over the last years since the imposition of rent control statewide and things of that nature. So, but it still works, right? You could still make a pretty good living.
you can still find a way, obviously. And where do you see it going next? Like as far as like with rent control and things like that, do you see it getting more protectionist towards the resident, or do you see it kind of maybe just moderating or staying the same, or getting more stringent?
You know, that's a great question. I did see within the last 5 years a movement to make it more stringent in certain cities, but it's become so appalling. Some of the things that have been done to specific landlords, and mainly it's not the big landlords. Like it's literally like certain, I'll call them atrocities that have been committed against like a little old lady who owns a triplex and she lives in one unit and rents out the other two. Like because there have been so many things like that, there's a movement now to kind of unwind some of these things. So it's kind of like anything. You hit that brick wall, and eventually people have had enough, and so they start unwinding these because they just took it a little too far, right? I mean, similar to like for a while you guys have heard like the ridiculous depowering of the police, or like decreasing what was once a felony to like a misdemeanor. Like namely, like I can rob you, and so long as I steal $950 or less, I can go to your liquor store, I can hold you up at gunpoint, break down your windows, and so long as I haven't done 900 in excess of $950 of damage, they're gonna catch and release me, right?
Yeah.
Well, that finally got repealed early, in December, and so you got people who are going in and doing the same thing, and then now suddenly they're being charged with a felony. They're like, oh my gosh, I didn't know they changed the law. Because it just was a bad idea and it was a failed experiment. And so, similar to rent control, there are certain things where, again, you're beginning to now see the cracks in the wall and beginning to go the other way. It's definitely far from a full on movement against it, but I'm really close to this stuff, so we'll see where it goes. Hopefully, it doesn't continue to get more difficult. Although the other side that is pro rent control is trying to make it even more crazier. And again, they've had that opportunity to do that in cities like Oakland, where it's just like, who wrote this,
Yeah, yeah. Obviously,
and
not somebody in law enforcement or somebody that
yeah,
lives there.
yeah, it's literally like, hey Scott, what's yours is mine, and what's mine is mine. And oh, by the way, your friend John there, what's his is
This
mine.
is mine too. Yeah,
And
you
it's
know,
like,
it's
you're like, how? Oh, hey, Brian, when did I agree to this? I'm like,
yeah.
the voters
How did
did.
this? How am I even a part of this?
Yeah,
You
exactly.
know, I'm always minded like when people steal stuff that people steal things or whatever. But I remember when I was probably like a college student, a little after that in Texas. Friend of mine, I'd stayed at his place, and he came out and his car was gone, and
Uh-huh.
come to find out it got stolen, and the police came and everything, and the police officer was there, and it was like a Toyota Supra. It was a nice car. It was a nice car or what have you, but they stole it, and he goes, well, hey, what are you guys going to do about getting my car? And he said, well, it's probably in Mexico by now. You're probably not going to get it back. So I'm just
When did this happen? When?
it was probably in the 90s,
Oh, okay,
and the
okay.
police officer was, I think it was Austin, Texas, or and he's like, yeah, it's probably gone to Mexico by now, so you probably call the insurance company. He was like so nonchalant that yeah, these cars get stolen all the time, and it's like so. I'm always reminded of like when there's stuff like that happening, in California where they say, they're not going to arrest him. They're probably not going to arrest that guy anyway because he's small time. It's like a waste of his time for even to run after it because he's not going to run after him because like what's he? Then he's got to do this paperwork and probably get sued because he pushed the guy down or whatever else. So
Yeah.
so I guess you got to pick your battles, but you've certainly carved out a lot of different places in California. And you're originally from the Bay Area as well?
Yeah, I actually, I'm an immigrant. I came over when I was 3.5 years old, and
Okay.
got my citizenship when I was like 7 years old. Parents came over as well, but yeah, I've been in the Bay Area since like 3.5, and I was
Oh,
like
nice.
1977,
Oh,
uh,
nice.
and not haven't gone too far from like I when my parents first immigrated from the Philippines. Was They lived in the city of Berkeley, and then we bought a home like just 10 minutes north of Berkeley on the freeway, and I grew up in the Bay Area, and again I was pretty privileged to be able to grow up here because it was a huge melting pot. Everything came
Yeah.
from like
I imagine it was a fun place to grow up. A fun place to grow up, I would imagine.
yeah, no, I very fun place to grow up.
Well,
Uh,
I know my older brother, he lives now on the kind of Nevada, which I guess is towards the wine country and stuff like that. But he was living in San Jose, and he said he would never live anywhere else because he just loves like all the things you can do there in Northern California in the Bay Area. You can go to the beach, you can go sailing, you can go to the desert, you can go skiing, you can go to Reno. There's just so many options. You can go out to the forest.
yeah,
And I do have to say, a lot of parts of California are just so breathtakingly beautiful, and it gets such a bad rap, but like from like real estate investors and the taxes and everything else, but it's kind of a breath of fresh air to talk to somebody like you that's doing it because there's obviously people doing it, making money, making a living and doing well at it. So when I hear these blanket statements and stuff, it kind of bothers me because people are doing it and making money. It's just it's a different set of problems. In Florida, we have problems as well. We have high insurance and we have hurricanes, and then we have somewhat of those type of problems where the cost to rent ratio is kind of out of balance, where if you buy something it may not necessarily cash flow in the long term, and then people are doing a lot of Airbnbs, and then the Airbnbs get saturated to where those prices come down and they don't necessarily cover either. So I know,
Okay.
especially in South Florida, you have, because the insurance costs, they really spiked up heavily after those several storms that we had. And I know also with they kind of went up all over because of the fires in California and also the floods in North Carolina, and those other, we had got hit with all those storms pretty quickly. So there's just kind of shows that, don't really listen to what people are talking about. Listen to the people that are actually doing it.
Yeah, no, no, good point, good point. And just to add to your comment, what a lot of investors are seeing as negatives to investing in California has really just occurred in the last 7 to 10 years.
Yeah.
And so I say that mainly because the problems that were created are artificial. They're literally just because of laws and politics that have been imposed, right? And so again, because it's man-made problems, it could be overturned,
Oh, yeah.
corrected. When I first started investing and buying in like 1998 and 1999, and again, I look back at those days and I'm like, wow, I was getting a 35% cash on cash return at a 11 cap, right, in California. And that's
Wow.
just because at the time you couldn't give properties away because we were just coming out of the S&L crisis, and so interest rates were like
Oh, right.
11%, 12%. And so they lowered the cost so much that, you could put 10% down on a fourplex paying 11%, and you're getting 35% cash on cash return, which turned into an 11 cap. So what I realized back then is that, hey, as the cap rates would come down, right, I went from 11 to like 10, it gave an exit strategy each time.
Yeah.
The guy who bought it at 11 or 12 to sell it at a 9. At
Nine.
a
Yeah.
9 cap, my guy who's buying at that is still getting it really
Yeah.
high. And then, it transitions into a 7, then he
Seven.
sells, right? But 7 is still high, and it came down to, I'd say, 6 and 5, and it's still
Yeah.
penciled. And so for me, like, it gave opportunity for multiple exits, multiple 1031 exchanges into bigger properties, not only for the guy who bought at 11 or 12 cap, but, and I stopped at around like the 5 cap, said, hey, you shouldn't
Caps.
go below this.
Yeah, five cap, that gets a little getting
Yeah.
under that gets a little sticky
Yeah.
in any game, really.
And then you're
Yes.
calculating debt service and stuff. But it was the laws were perfectly workable back then, right? And so, in addition to all those wonderful things about California you mentioned, it was a great place to do business, right? Which is
Yeah.
why tech and fintech all blew up here.
Yeah, that's right.
And that was the whole reason why I ended up going into other states, because I was like, man, this 11 cap, it's not here anymore, right?
Yeah, yeah.
And so, like, hey, there's a 7 cap over there in Tennessee and a 6 cap. But, again, after having bought those back in 2002 and then exited them in 2015 or 2017, I could now look and compare side by side. I'm like, hey, these properties, even the ones that I bought at a 6 cap in California, eventually got up to a 9 cap within like 3 to 5 years. But the ones that I bought at a 7 cap or a 6 cap in Tennessee,
Still
it
probably a 6 or
went
7
beyond
cap.
that ever,
Yeah, yeah.
right? Like the
Yeah.
rents that are like, the rents are, I went like from 475 to 525.
Yeah, it was just a cash flow play, really, where you get just incremental, more cash flow, steady.
Exactly.
Probably like flipping a coupon for a bond or whatever. It goes up incrementally or what
Yeah.
have you over time. But I guess you know, with what you're doing, did you eventually move a lot of your stuff back to California pretty much and sell off a lot of the things that you had out of state?
I did. I still keep properties out of state because what I also realize is like, hey, even though they don't, their appreciation sucks, right? Because just from the quantity, they still provide a lot of cash flow, which is just kind of good for maintaining everything else. But it also gives me that ability to take bigger risks.
Mm-hmm.
So if I go into something where I know, like in California, for example, right, where I'm trying to buy something in California and I'm buying at a lower cap and I know what problems I'm dealing with or I'm developing and I know it's going to be difficult, it gives me that staying power because, I'm not worried about paying a mortgage. I'm not, and I structured all of my companies that way so where at least I know my employees are paid so I could then go, okay, let me, I don't gamble. So I'm like, let me take these gambles and put my cash or my investors and my partners money out into projects where it might take a little bit longer, but if we hit it, it's going to be
Bigger.
out of the ballpark, right?
Yeah.
So it was a little bit of a mixture of like keeping a conservative foundation, not only on the investments that I'm buying, but in the way that I'm running the companies that I have, so that I could then take those swing for the fences on certain other projects. Of course, still doing the due diligence, right? Not going in
Yeah.
there blind and just thinking that it's going to be easy.
Yeah.
And so some of those times you find yourself going, "Gosh, why did I leave my nice life?" Like why am I putting myself
Yeah.
through
Why
this
did I jump into this at
this
all?
torture, right? It's
And
like
I
giving
would say,
birth, right? And
I
then,
would
and
say
then,
it's,
and then when the project finishes, you're like, "Oh, that wasn't so
yeah.
bad."
Yeah. Usually after it's done, a little bit later, you're like, oh, that wasn't so bad. And then usually our wives or somebody goes, yeah, it was.
Yeah, exactly. Yeah,
Maybe not. Maybe you might be okay now, but we're not.
exactly. I'm still suffering from the PTSD that you went through on that one, but you
Yeah.
forgotten and we're okay
Yeah,
with it.
that's why I need a vacation.
Yeah, yeah,
That's why I'm going to wine country for a couple of weeks, and you
exactly.
come.
Oh, the beautiful thing, like where I'm talking to you from right now, my office is like 15 minutes from Napa or wine country, right? Like,
Oh,
so
nice.
it's like 15 minutes from like well, 15 20 minutes depending on traffic to San Francisco, 15 20 minutes to Napa the other way on 2 hours skiing. So it's kind of like you still walk out the door and you're like, okay, at least I know why I'm putting myself.
Yeah, yeah. At least I know I'm still here.
Yeah, yeah,
But I like your strategy because it gives other people an example of like maybe you diversify by being in a different location because real estate is all local, so each area has its different you know employment culture, has its different population, demographics and everything else that's moving there. And then like out of state you get that cash flow, that's your base, that's your steady income that just keeps everything going, which allows you to have that base to where you can go and take a larger risk in California or somewhere else that you can only do in California or somewhere else, so you can get that bigger payoff. Because with a bigger risk, you're going to get you know a larger payoff generally if you do all your due diligence and everything else. And I would say that you're not a gambler in the casino, but you take those calculated risks in your business by saying, okay, this is a bigger risk, but the payoff is probably 4x in
yeah.
10 years. But the ones in Tennessee or Texas are probably going to be maybe a 2x over 10 years or something like that. Or you pay down the mortgage and then you use that for leverage, which is a great example of over time, in any market, if you're paying down the principal, you also get that advantage too, to where you can use that as leverage to buy more properties in California or other places. That it just kind of keeps in one way. I imagine the way all your businesses are structured, that each one is helping, you know, subsidize the other at some time. When one is down, the other one is kind of helping offset the other ones.
Right now, that is, yeah.
Yeah,
When it's going good, they're all just
they're
like
all doing well.
saving
Yeah,
cash,
yeah, yeah.
In fact, like when when my real estate business is doing really good, like when my brokers are just, doing their
Killing
thing,
it, yeah.
selling, and I'm still selling, the building I'm in will charge extra rent to the corporation, to pay for its, units. I own the
On the
building
building too.
here,
Yeah.
right? And it's a 21,000 square foot building, and we occupy about 2,500 square feet. At one time, I occupied 5,000, but because everything has gone virtual, I don't need as much footprint anymore, right? So
Yeah,
I
yeah.
shrunk that down just to a minimum of 2,500 square foot. But I rent out all my other spaces. But I'll still each of the businesses will still pay extra rent, to the building, and in times when the market is doing good, for my agents and my brokers working under me, as a broker, I'll pay extra rent to the LLC that owns the building that I own, because
Nice.
that's it. I can apply my depreciation to that rent, and then because I'm in the business, I can apply accelerated depreciation and just really balance it. But right now, to your point, yeah, when things are bad, one is keeping the other afloat.
Yeah.
Uh,
Well, because you have those, it's the same thing with your rental properties, and some of the properties in California may take a little bit longer to pay off at that level, but you still have the cash flow coming in that can kind of subsidize all those
yeah, yeah.
different with the cash flow and the multiple different business strategies. It gives you more options. So like, what can I tweak here and there to get a little bit more here, or get a little bit less here? But I would say you probably have, it's pretty evident to me that you probably have a lot of great people working for you, and they've probably been with you for quite some time.
Yeah, you hit it on the head. I have some people that have been with me for 20 plus years, and some of them, some of
Amazing.
my clients, their kids work with me now. So I don't have as many brokers anymore as I used to. Like from like 2000 to 2010, I had like 80 brokers, 40
Wow.
loan officers, and like 40 support staff. Right now. Um, it's just 20 brokers, and most of them are core. At some point I might recruit again, but like I've been doing it so long, I'm like, sometimes I'm like, I don't want to train somebody new again, right? And plus that business kind of is taking care of itself. But I've had that privilege of having really good guys working with me. A couple of them are now CCIM instructors, and and
Wow.
teaching this stuff, and uh, so it's been cool, right? In fact, one of the new ventures we're going into is I've actually started encapsulating a lot of the knowledge in it, and we're preparing a series of modules to kind of highlight the experience, because I was kind of inspired by what was his name? Gosh, it was right on the tip of my head. Um, what was that pod? He's a video. He does YouTubes, and he does he does the videos that explain how he took his gym business.
Oh, Alex Ramosi.
Alex Ramosi, yes,
Yeah,
yes,
he's great. Yeah.
yeah. He so as people would talk to me, like, did you ever watch Alex Ramosi? I'm like, who's that? And I realized I have been watching him, right?
Yeah, yeah.
And so as I started listening more intently to what he was saying, at the core, he took the main tenets of running a successful gym, as a
In
and a
every
personal
business.
trainer, and then applied them into a mantra of business practices that then he turned into YouTube stuff, and then and modules that he charges for, right? And so I was like, oh, that's brilliant. In fact, from the business of those modules, he was talking about how he bought a building in Las Vegas, and he uses that, he pays rent to himself and things like that. So I was like, oh, I've been doing that for the last 21 years. So we started filming a series of videos that kind of talk about my own personal experience, and like that entrepreneurial mindset.
Mhm.
How do you create the exponential growth, and like try to define how clarity is power, but more importantly, how a lot of just implementing the tax laws, the rent control laws, whatever, to kind of change and up your game depending. But a lot of the things that I would do, were applicable to any business regardless, right? Especially because one of the aspects of my business is that I would help a lot of my entrepreneurial clients that maybe ran a restaurant or ran a school to acquire the building they're in using an SBA loan, so
Hmm.
that then they could pay rent to themselves, or their business can pay rent to the building
Yeah.
that they own, and just kind of work this dynamic of getting rent from their own building. Like for example, the SBA only requires an owner of a building to occupy 51% of the space.
Hmm.
And if they're an owner operator, then they only need 10% to buy this building. So, I just kind of run the numbers from the client and say, hey, you want to 10x your restaurant, you want to do this. And, I have all these different cases. Like I had a client that came along who was a Mandarin immersion school, right?
Oh, wow.
They would teach kids who, it started at the daycare level, right? You bring your kid to their daycare, and it's Mandarin immersion. Well, that went from like daycare up to sixth grade, and then they had bought three different houses, and they were running a daycare where you could drop your kid off, and they would learn uh,
Man.
Mandarin. So we took that business and we got them. There was a Montessori school that came on the market, and so we were able to buy them a campus with 10% down, and basically funnel all those students there, and they occupied just really 51% of the space, and then they rented out the other portion, the other 49, to another complementary tenant. But now they had this huge wait list of 2,500 students, and so we funneled a lot of them through there, and so now they're just running. You have all these people coming in and dropping their kids off at a
Oh,
Mandarin
wow.
immersion school, and that was in San Francisco, right? So in a place
Wow.
where it's difficult to buy, you're still able to find these niches. And so from examples like that, I was like, hey, there's classes behind that, and I should probably start just
Yeah.
putting those down. And so we've been working on these modules and announcing it to different people. And so there's a lot of interest in it. Again, it's just another spin-off. It'll be another company that runs as a vertical to
An
the other companies. Yeah.
educational vertical one. And that's great because that's, it's something that everybody always needs more knowledge in, and I know I'm always learning and like this, I got a lot out of this conversation because there's a lot of stuff I learned about California and just, it just goes back, it runs me back to that same thing. There's always a way. It might not be something that you really thought of or really want to do, but it might be what you have to do to make that thing work. But that's a great example of how buying the building using an SBA loan, and the business has to pay rent somewhere. So why not pay for the property and own the building yourself? And then at the end, if you want to sell the business, you can keep the building as well and still
Absolutely.
get
Yeah.
cash flow.
Yeah. Yeah.
And it's I saw a prime example of that with a friend of mine. He bought a warehouse in Fort Lauderdale, and it was an SBA loan, and it was at a time when the rates were really low, and it was like 2.6% interest or something like that, and
Mhm.
he rents 49% to somebody else, and that covers the mortgage. So his
Yeah.
business is basically there uh, for free,
Yeah.
and he's thinking of winding down the business and selling off the business and then just renting the other half, and then you know he has you know that piece on top of it that he has as cash flow every month, and it's quite a ridiculous amount compared to the equity as well, which I think he bought it pre-COVID, so it's probably a 4x.
Yeah, you hit it on the head, Scott. Yeah, no, that a lot of people don't know that there's those opportunities, right? And so like, being in the real estate industry, like, and having a commercial retail division or just leasing, we'll come across people all the time,
Mm-hmm.
like, they're going to open a restaurant. And those restaurateurs, they spend like a lot of money on tenant
Yeah,
improvements to make these restaurants look gorgeous, but they don't
build
have
out.
a place, right?
Yeah,
And they, just the kitchens alone, like the grease traps and everything, it gets up there.
and all the regs. Yeah,
Yeah. And sometimes, if people don't like your food, that's restaurant doesn't.
yeah, that's doesn't fit in this area. We don't like that, whatever kind of food that is.
Yeah. So and again, this same model could be used for dentists, could be used
Yeah.
for. I did a similar one, like I said, for myself back, like when I bought this building, it was like 2001. I was like 30 at the time, right?
Yeah.
Like, but but part of it was just I was nervous because I was 30, even though I had been successful. Like, man, I don't want to go out of business and not be able to pay rent, right? So,
Oh, wow.
and so
Yeah.
I just wanted to make sure, like, I can keep the longevity of my business and, and kind of just keep doing that. And so, just along the years, there was a lot of tools and nuggets that I started realizing, hey, this is stuff that a lot of people just it doesn't come common sense to them, and so kind of educating people to this stuff could really help up their game, but give back to the community and figure out different ways to kind of reconciling between landlords and tenants who are protected by rent control,
Yeah.
that kind of stuff.
Well, this has been, again, I'm glad having you on was has been really great because our conversation was so. I remember we turned around the other day and we were talking. We talked for over an hour, and we've done the same here again. So just before I forget, Brian, where if someone wants to get a hold of you, find out about your education, about your brokerage, about your mortgage brokerage, your commercial property, and just find out more about you just to get some more education, what's the best way for them to find you?
The easiest one would be just type in the email of the real estate company, and that's bcre.co. But there's multiple ways to get a hold of me. If you just type in my name in California into Google, you'll see all the different links. But the other one would be ascendpartnersgroup.com, which is a new vertical that I've started, and that actually has a Calendly function that they could get a hold of me from.
Oh,
Or
that's great.
my assistant Mark Miller at bcre.co could reach out to them, and they'll be able to get a hold of me and schedule something.
Yeah.
Yeah, so it's
And
pretty.
we'll definitely put all those in the show notes and everything so people will be able to find you. Well, thank you so much for being on here. And this will definitely be to be continued because I really like talking to you about just learning all the extra nuances, and you have a world of experience that definitely needs to be shared. Thank you
Thank
so
you.
much.
Yeah, and I'll look forward to the next conversation, Scott. This was definitely very pleasant.
Thank you so much. This is the Yacht Captain Investor podcast, and this is a gentle reminder to invest in yourself because that's the best investment you'll ever make. Thank you, guys.